Good afternoon, everybody. Delighted to be here. We've put together just a few slides and some key points that we hope will be very clear and very informative for you all. So I'll be sort of covering the main design elements of auto-enrolment, what's in the agreed design from government, the one that made its way into the legislation, and some of the sort of nuances around all of that, and sort of a high-level overview of how it will work for employers before John sort of will get into maybe the operational nitty-gritty and payroll side of things. So I'm sure there's a level of familiarity here within this room. We've been talking about auto-enrolment for a long time, and we've been sort of gradually sort of raising people's awareness, and we've had an information hub available for a long time, so you'll probably have a reasonable sense of it. But I just want to make sure that you sort of achieve today a clearer understanding. So let's look first of all at the eligibility criteria. So any employee who's earning over 20,000 euros per year and is aged between 23 and 60 and is not already actively contributing to a pension scheme through their employer's payroll will be automatically enrolled when we launch next year. So a couple of things about this. First of all, the person's employment status or the type of contract that they're on doesn't matter, except insofar as they are an employee and they're not self-employed. For anybody who's outside those age and earnings threshold or those sort of criteria, they'll have the option to opt in. In other words, if you're aged 18 to 23, you'll be able to opt in, or if you're over 60, you'll be able to opt in. But they just won't be automatically captured, if you like, in the first run. And if they do opt in, the obligation will be there on their employers to support them the same as any other employee. Anybody who earns less than 20,000 euros per year, particularly people on, say, in part-time work, will also have the option to opt in, and the same rights and obligations then will flow from that. So auto-enrolment, to be known by its brand name, MyFuture Fund, is a very sort of an automated system. It's very payroll-based. And really, it's for that reason that the self-employed have not been included in the design. The self-employed, obviously, their earnings fluctuate, how they sort of pay themselves, or they might put in, invest in their business or whatever, sort of ebbs and flows. They don't have an employer and sort of a payroll that they're registered on. So they're excluded from it. However, they do obviously benefit from the entire pensions market that's out there. They have lots of options available to them in terms of saving and investing for the future, and they will get tax relief on any pension contributions that they make. So it's not for them. It's also not for the non-earning. For anybody who's, say, on a social welfare payment, or anybody who's just not earning through payroll, they won't be included in auto-enrolment. Now, that's still about 750,000 people currently in the workforce who we've assessed meet this eligibility criteria from the outset. So it's a big chunk of people. About 2/3 of workers currently in the private sector are thought not to be actively paying into a pension. And many of the people who are actively paying into a pension aren't paying at sort of sufficiently high rates. So we have a pensions coverage problem in this country, and we also have a pensions adequacy problem in this country. So we're doing our best to solve at least the pensions coverage problem, and as the contribution rates increase for auto-enrolment, we'll gradually solve the adequacy problem as well. You'll all know that there's an issue with the state pension in terms of the way the demographics are going. So we'll have more and more older people and pensioners in this country, and fewer younger people paying into that system in the future. But the problems of the state pension are the problems of the state pension, and that has to be dealt with sort of separately. So this system is supplementary to that, and anybody who might have an entitlement to the state pension for whatever reason, whether it's through the contributory PRSI model or the non-contributory model, whatever it is, anything that they save through auto-enrolment will be in addition to that. Now, I just want to sort of tease out a little bit with an example what we mean by the €20,000 earnings threshold. So, a person can earn €20,000 over any number of employments. And what's here, now I know this is a busy slide, right? So you'll have the slides afterwards. I'll just talk you through it now. So what this is an example of is a person who has 2 jobs. You'll see in the left column there, job A. They have no pension in job A, and in job B, they also have no pension. Now, their pay in job A and job B, both of those are under the €20,000. However, together, they earn over €20,000. Therefore, they're potentially in AE. And so what will happen in this particular scenario is that starting with the contribution rates of 1.5% for the first 3 years of the operation of this scheme, the employee, the employer and the state will all make a contribution into the savings pot in relation to job A and job B. Now, if I just give you a little twist on that scenario, here's the same, or a different person, say, also with 2 jobs earning the same amount of money. So together, over the 2 jobs, they earn €25,000, so they're in. But in one job, they have a pension, the other, they don't. So what happens there? What happens is that in job A, the employer does indeed have to contribute towards auto-enrolment or MyFuture Fund on their behalf, even though they only earn €10,000 with that employer. Job B is considered an exempt employment, and so contributions go in respect of job A and not in respect of job B. I just think that's an important kind of a nuance to bring out here, because I think a lot of employers think that, oh well, if Mary doesn't earn €20,000 with me, then it doesn't apply to me, but in fact it might. And as an employer, you might not know what other jobs Mary has and whether or not they go over the income threshold. But the new authority that's being set up and the revenue commissioners will know and will be able to inform the employer. Now let's look at the contribution rates, and again, I just want to deal with one issue that can cause confusion. So the contribution rates for MyFuture Fund are being gradually phased in over 10 years. And this came about because back in 2018, when there was a public consultation on a sort of a straw man design, these rates were different and they were being phased in over a shorter period of about 6 years. But a lot of feedback from stakeholders at the time, particularly employers, sort of said, this is too much too soon. They're getting too big too soon. We need to stretch these out. So as a result, the contribution rates are being phased in over 10 years. So they start at 1.5% of the employee's gross earnings for the first 3 years. Then they auto-escalate up to 3% for another 3 years. Then they auto-escalate up to 4.5% for the next 3 years. And then from year 10 onwards, it's 6%. Now, to just tease that through a little bit, first of all, the contribution rates in auto-enrolment are rigid. They are set down in legislation, and no options are there to pay more or to pay less or to pick the amount that you put in. They're just set. The second thing is they're set for these years. So MyFuture Fund is going to launch in January 2026. So the 1.5% rate applies until 2028. If somebody joins in the year 2036, say, they're automatically going to start at 6%. So it's not the 10 years that they're in auto-enrolment, it's the 10 years of the existence of auto-enrolment that matters here. Now, I just want to talk you through a couple of features of auto-enrolment that are kind of nuances, because we call it a semi-mandatory system, and we're getting to the semi bit of that. So A worker, if they want to, can opt out of auto-enrolment, but they can only do so after 6 months mandatory participation. And I suppose the wisdom of this design feature is so that workers can see their savings building up, fairly quickly over the period of 6 months. And with the relatively low contribution rates for the first few years, they'll be able to, it won't hurt them too much in terms of affordability, so they'll kind of get used to it. And the presumption, and this is how it has been in many other jurisdictions, the presumption is that people will sort of accept it and get used to it and will get into a savings habit. And they will cultivate a savings habit that they may not have proactively gotten around to themselves. There's a lot of inertia when it comes to savings and pensions, and a lot of people kind of do think it's a good idea and they do kind of want to do it, but they just don't get around to doing it themselves. So this sort of takes the inertia out of it for them. Now, if somebody opts out after 6 months, they can only do so within a kind of a window of months 7 to 8. And if they do that, the worker will get a refund of their contributions. However, they won't get a refund of their employer's contributions or the state contributions. Neither will the employer nor the state. That money will stay invested in that person's pension pot and for time immemorial until they reach the age of 66, and they can get the money then at that stage. And what this means is, we believe it means that very few people will opt out, but it means that they will always have a certain amount of money saved and invested in their pot. The only option available to them, apart from the opt-out windows, and by the way, there's some details I could go into there, but I don't want to kind of bamboozle you. There's more information on exactly how opt-outs work. But what's important, I think, for the audience to know is that it's up to the employee to opt out if they want to. There's nothing for the employer to do. The employee will kind of go to their account through the portal and decide to do that within those restricted windows. What they can also do then is they can suspend, which is like a pause button. They just stop paying into auto-enrolment for a period. And if the employee stops, so does the employer. But again, it's at the prerogative of the employee. The state will also stop contributing for that period. And it's up to a maximum of 2 years. So, we kind of jokingly call it Hotel California. You can check it any time you like, but you can never leave, because after 2 years, you will be brought back in again if you still meet the eligibility criteria. So we've sort of done some modelling, like if somebody starts at the age of 23 and they start paying in, and then they repeatedly opt out and get brought back in for the mandatory 6 months period, and they opt out again, all of that, they will, despite themselves, have some sort of a savings pot at the end of it all. But we expect that most people will find auto-enrolment or MyFuture Fund to be a good option for them, and they'll just stay in it. Now, a couple of other key features. The first one I want to just mention to you is the pot follows the member feature. And I often think this is probably the best feature of this particular design. We know from other jurisdictions, particularly say the UK model, that there's a big problem with a sort of a proliferation of small savings pots, small pension pots around with lots of different providers. And they're gradually kind of getting eaten away by the charges on them, and people lose track of them, and they can't remember where they are, and they leave the country, and all that kind of stuff. But with our system, everything will be held centrally. So it's sort of tied to a person's PPS number, and it's going to be held centrally by the new authority that's being set up, I'm going to tell you about in a minute. And so you can have any number of employers and any number of jobs and any number of periods outside the workforce, but at the age of 66 you'll have one central point to go to access all of those savings. So that's a very strong feature, I think, of this. The money will be invested on participants' behalf. So this is important because not only will they have their own contributions, their employer contributions and the state top-up, but the money will be invested and will hopefully grow for them over time. Typical investment returns over the last 30 years have been in the region of about 10%. Now, we never expect that to sort of continue sort of forever, and whenever we're doing sort of actuarial calculations, we make it at a much lower rate, but it'll be a bit extra on top of that. So for the first number of years, the investment houses that we're going to be dealing with, we expect, will be Amundi, BlackRock and Irish Life Investment Management. We had a big public procurement there earlier this year, and we've nearly finished the build with integrating with them. But whoever it is, the point is that the money will be invested by the new authority on the participants' behalf. Now, this money belongs to each individual worker. Okay, this is not a state fund. There are other state funds out there being set up. Another one also has the title Future in it, but this is like a personal bank account, a savings account, and people will be able to log onto a portal and look at their account sort of that way. I log on to PTSB and I see what's sitting there. Likewise, workers will be able to do that here as well. It's their money. It can't be touched. It can't be snaffled away by the government for any other purpose. It's their money. Then drawdown time. So we have in the design, and the Oireachtas has decided through the legislation that the drawdown age will be at the age of 66. So it's aligned with the current state pension age. As I mentioned, it's supplementary to the state pension. It's not instead of it, and it's not going to undermine the state pension in any way. At the moment, the only drawdown or pension product, if you like, that's going to be available is a lump sum. And the person can do what they want with that. There's a whole pensions market out there. If they want to turn it into an ARF or an annuity, they can go and do that. But for the first many years, that won't really be a relevant consideration because the contribution rates are quite low, and the first people to come in, say, and access those drawdowns are people who are kind of the age of 59, say, or thereabouts. So they will build up a savings pot of, a few €1,000, and the maximum that they're going to build up in that period of time when it comes time to have the first drawdowns is going to be within the so-called trivial pensions bracket. So what that means is that when on drawdown, the tax treatment for this would be pretty much in line with, say, a PRSA or some occupational pension scheme. And many of you will know that there's a 25% tax-free feature for those lump sums. But in reality, auto-enrolment for the first number of years will be sort of 100% tax-free because it will be considered to be a trivial pension. In time, the new authority and the people who are on the board, and the CEO and all of those people will decide on maybe new other pension products, and I wouldn't be surprised if they either procure or design other products, but for the moment it's a lump sum on drawdown. Now I want to talk to you about this authority. I've mentioned the authority before, so we call it NERSA. So it's a National Automatic Enrolment Retirement Savings Authority. Just rolls off the tongue. So NERSA is this central kind of one-stop shop for all things MyFuture Fund. So this is important, I think, for employers, for HR people, for payroll people, as well as for the employees who are going to be enrolled, to know that there is a central point of authority and a central body which has statutory independence but sort of hangs off our department, the Department of Social Protection, and it will have all the powers and functions it needs to make sure that MyFuture Fund works well and in the best interests of employees. So this is important for employers because NERSA will be doing the administrative work. And NERSA will not charge any fees to employers or HR or payroll people to interact with it. So this is, I suppose, in contrast to the experience of a lot of employers who already have occupational pension schemes, which can be a little bit difficult to operate. This will be the simplest thing in the world, and so employers who already have an occupational pension scheme, I think some of them have been worried about, quote unquote, running two schemes side by side, but they won't be running two schemes side by side. You know, NERSA will be running MyFuture Fund, not the employers. So NERSA will determine eligibility based on the payroll data and all the data held by the revenue commissioners. They will inform the employer that their employee or employees meet the eligibility criteria, and they will send out a payroll notification to that employer and say, Mary is in, apply this 1.5% to her and pay over the contributions. I mean, I'm saying it very simply there. NERSA will facilitate all of that opting in and opting out and suspension. They will manage the re-enrolment. They will manage the contract with the investment managers and the managed service provider. They will do the payouts at retirement. They will do the monitoring of the compliance. They will manage the website. So there'll be little or nothing for employers to do. There'll be a couple of steps to take in the beginning, and we'll take you through that, but it'll be a bit of a once and done for employers, and employers will find it not a burdensome thing to engage with. I just want to show you this little overview here, and the purpose of this overview really is, you know, I think sometimes figures like 1.5% of gross earnings sort of swims before the eyes, but in a simple way to look at it is that for every €3, you see the 3 coins up at the top there, for every €3 an employee puts in, that will be matched by their employer, and the state proportionately will put in €1. You might have seen sort of our ice cream ad over the summer, and you might have seen these sort of references to 3, 3 and 1. So for every €3 a worker puts in, it sort of automatically becomes €7 in their savings pot, and that's even before it's invested for further growth. So that money will be collected, will be given to NERSA. That will be then invested by NERSA on the participants' behalf and eventually flow into the big jar down the bottom there, and the employee can access that on retirement. So there's no early access under this scheme. It is, you know, perhaps more rigid than some other pension arrangements. So if somebody prefers a different kind of pension arrangement, they're more than welcome to go to that. And all they will have to do, if they want to go to that, by the way, is to start actively paying into it through payroll. NERSA will then know that, and they will drop out of AE or drop out of MyFuture Fund. MyFuture Fund is sort of like a sweeper system. It sweeps up any of those people who don't actively have any coverage either through their employer because of, you know, they've taken steps themselves to pay into something through their employer's payroll. So in simple terms, and John will go into this in a little bit more detail, in simple terms, NERSA will identify the eligible employees, not the employers, okay? NERSA will issue what we call an AEPN, which is an auto-enrolment payroll notification. You'll all be familiar with revenue payroll notification, so this is the auto-enrolment payroll notification. That will be issued electronically through payroll. The employer then will get the latest AEPN, in other words, just make sure that they've selected on the most up-to-date sort of instruction through the software. I know people use different kinds of payroll providers. Then they will apply that contribution at the prevailing rate. So for the first 3 years, it's going to be 1.5% of the employee's gross earnings. So whatever's in that gross earnings field is what the 1.5% gets calculated on. They will send back that contribution file, again, electronically, and the contributions will be collected, but that means is the money is handed over, and then they'll be invested on behalf of the worker. So the role of the employers or the payroll operators is to get that payroll notification. And this is, not yet, but when the scheme launches, pay it, return the contribution file, and inform the employee if it's their first time being enrolled. There'll be sort of some communications templates and letters if employers want to use them. they'll be sort of available to employers on the portal, sort of as inspiration for how you might want to tell your employees. But obviously, there's lots of different ways of telling employees. People have phone numbers and emails and conversations, and they can do it that way too. What it means for employers really is that there's minimal administration. You know, we really wanted to make sure that with this design that we didn't put it onto employers. Other jurisdictions have employers picking different pension providers and doing all kinds of stuff. We didn't want that. So we've got this central authority. And then apart from that, the employer just has to sort of comply with the legislation. So what that means in terms of just talking through the compliance piece a bit is making sure that if an employee is in, that the employer doesn't try to convince them that they ought not to be in or induce them not to be in. The employer obviously has to pay the money, and otherwise, there's the legislation contains some penalties around all of that. Is there anything in it for employers? Some employers think not. They think it's simply an increase in their costs. But trying to look at it more positively than that, we have a very tight labour market. People are competing for good staff, and they're competing for talent. So, having a pension available to workers can often be a big pull for workers, and conversely, not having one can push workers away. So at least this levels out that sort of playing field, and it gives employees a sense of sort of well-being and reassurance kind of for the future that a lot of employers weren't able to give up until now. In this, particularly in Ireland, we have a very kind of small to medium enterprise what's the word I'm looking for? Kind of, landscape, if you like, employer landscape. Other places, they have much bigger employers. But we have an awful lot of very small businesses, and they're never going to get around to setting up their own occupational pension scheme. So at least it solves that problem for them. For those employers who pay corporation tax, it is deductible for that. I know not everybody does, but it is deductible for those purposes as well. So there's a predictability to this for all concerned because the rates are set. You should be looking now at maybe looking at budgeting, trying to figure out how much is this going to cost. Obviously, with the contribution costs phased in over a decade, what that means is that those costs can gradually be absorbed as well. There's going to be, I'm sure, wage negotiations. And so the ESRI even looked at this and kind of said that there will be maybe an impact on wage increases, but not a very negative impact on wage increases, be gradually absorbed over time. Some employers will also look at what, pension coverage they already offer. Some are doing things like they are inviting workers to join their existing occupational pension scheme. Some of them are changing the terms and conditions of those to get rid of waiting periods and vesting periods and all of those things. And because there is no waiting period in MyFuture Fund, it's sort of a day one application. So if the worker isn't actively paying to a pension, they could be in from day one. They just have to make sure that their software provider has kind of updated their software. There's Trojan work going on at the moment with over 60 payroll providers, sort of under the umbrella of the Payroll Software Developers Association, and they're on track to get most, if not all, of the software providers' software updated to sort of be able to absorb all of these changes. John will sort of maybe talk a little bit more about this, but in terms of how to discern whether somebody meets the eligibility criteria. So when we're looking at whether or not they earn 20,000, for a lot of people that will be apparent immediately that they're on track to earn 20,000 in every year because in previous years they've earned that and more, right? But there will be a 13-week look-back period for workers where it isn't maybe apparent immediately that what they earn. So if somebody earns 5,000 euros over a 13-week period, they could potentially be auto-enrolled, obviously 13 weeks being a quarter. If somebody runs payroll, say, on a Monday and a person is getting paid on a Thursday, the employer or the payroll provider will have up until 6 o'clock on the day of payment to make any adjustments or corrections. After that, then, there's no scope for corrections. I think this might differ a little bit to how the Revenue Commissioners operates, because at that point, the payment that goes to the worker will also go off to NERSA, if you like, almost in real time at that stage for investment. A couple of points just to note, right? So employers will be asked in the coming weeks, when the portal is available around December, to complete their profile on the portal. I already mentioned there's no waiting periods for auto-enrolment, and we already spoke about multiple employments and how all that works in terms of, you know, adding up how much a person earns in a year. At the moment, there's no minimum standards for pension schemes that will deem an employment exempt, right? So what I mean by that is, if somebody next January is paying anything at all into a pension scheme, and that is visible to NERSA through the payroll, that worker won't be enrolled, okay, because they're in a pension scheme, right? But in time, in about 6 years, in fact, because the legislation says that by the start of year 7 of the rollout of this, standards will be set. So the Pensions Authority is going to look at what do we expect pension schemes to offer a worker in order for that employment to be exempt from auto-enrolment. Because what we're trying to avoid here is the idea that, you know, 1 cent a week into a pension scheme is enough. You know, eventually we want to make sure that those standards are good, that, you know, that this is something that really enhances workers' employment rights. It only becomes kind of really relevant, you see, after 6 years because of the gradual increase in the contribution rates. Because for the first 6 years, we're moving from 1.5% up to 3%. And a lot of employers, if they have a pension scheme at all, they tend to do the kind of 5% plus 5 from the employee. Now, there's loads of variations on all of that, but it's after 6 years that we're really kind of getting into that relevant period where we'll be kind of comparing auto-enrolment or MyFuture Fund to other pension schemes. And really the golden rule, whatever way this shakes out, the golden rule will be let the worker not be worse off in one pension scheme than another. And that's not solely, something that you can decide based on contribution rates, because sometimes, like other pension schemes might have earlier access, they might have other benefits associated with it. Sometimes employers contribute, sometimes they don't, sometimes it's calculated on base pay, sometimes it's calculated on gross pay, all of these kinds of things. So there's a few different factors that will go into it. You know, what tax relief is applicable to the worker, all of those kinds of things. So you don't immediately know which is better for the worker. You'll have to sort of think about that. But for the moment, anyway, for the first few years, any payment into a pension scheme will, through payroll, will deem that employment exempt from auto-enrolment. Now, I've tried to just hit on the key design points. We will have a Q&A at the end for anything that you want to clarify. We also have an information hub. So if you look at www.gov.ie/auto-enrolment, there's loads of resources there. There's FAQs, leaflets, information on how the whole thing works and where it came from. There's also on the department's YouTube channel a really informative set of videos. I think in total it's about 18 minutes, but they're broken up into different chapters where essentially kind of what I've just told you, but with a few other bits will take you through the design if you need any further clarity on it. There's also a contact email address there if you want to follow up with us, and one of the team will get back to you. So that's sort of the whistle-stop tour, and as I said, we'll have a Q&A at the end of this. So thanks very much for your attention.
Okay, good afternoon. I'm John Egan. I work in the operations side of this project, And I'm going to walk you through at least here, it's the prototype screens of what the employer registration piece is going to look like. Now, what's on screen here is it's an incomplete, it's a sample website here. And a lot of the words you might see, or some of the words, will change between what's here today and the live version when we launch. So this here, it's a dummy text, but there's going to be a website for MyFuture Fund, and within that website, there's going to be an area where you can get information if you're a participant or if you're an employer or an agent. I'm aware on screen the text is a bit blurred, so I'll try and talk through and explain what's on the pages and what the task is at each point in the registration. Okay, 1 second there. So these first 2 pages, again, these are just copy pages. There will be a version, there will be a full website here, but I'm starting a journey as an employer, and this is going to be my registration piece. Now I can expand the screen back up there. And this is, you might be more familiar with them than I am, but registration is using the ROS certificate. This is a mock-up of the registration screen that Revenue use for their ROS certs. And we're going to use that same technology to log into the AE platform. So these screens here will represent those screens. Again, you may be quite familiar with that Revenue use to log somebody in using that ROS cert technology. So we're just logging into the portal here, and you're going through your ROS screens. And at some point then, we will land in the registration. So this is the registration for an employer into the MyFuture Fund, where we learn all about the company profile. We get details about contact people, that kind of thing, and we go into setting up payment methods, so direct debit or else. And this is what the screen will initially look like. And we'll begin the journey by clicking Start down here in the bottom. So the first thing that comes up then is to agree you've read the terms and conditions, which will be available through those 2 links there. And you'd read them and you'd move forward. And here we're now into the beginning of the registration piece. So here we're looking to populate the company profile. So again, I'm not sure if you can read those boxes, but on screen we've got company name, we've got trading name, business sector, number of employees. And that's a drop down, it's a range. And it's like that determining the size of your company. We have a language preference, we have method of communication, so whether it's electronic or whether you want to take your communications through paper. So we complete this screen like that. We put in our company information, and then we scroll down to the bottom and we'll give our address. So address, as we'd be familiar with in most websites, we can use air code or we can populate our address manually, and we'll put in our information and we'll continue. So that's the first piece done. So you'll see on the left-hand side is a green tick on terms and conditions, and we're satisfied with that piece. Now the next bit is about the primary contact, who we're going to deal with if we have an issue, and this could be whoever runs your payroll, it can be a HR member, whoever it's going to be, needs to be a person that will be there and will be contactable if we have an issue. So we're filling out here, first name, the middle name is optional, family name, a phone number, and an email address. So when you're populating this information, it's important to realise that this is what we'll be looking at if we have an issue, we need to contact you. So the details that go in here should be relevant. It should be the appropriate person, whether it's an HR person or somebody who runs payroll, because that's the person we'll be ringing up if we have an issue. I hit save and continue on this screen. And now we're into the payment method. So our primary payment method here is direct debit, but there's a couple of different options. And I'm going to walk through the direct debit piece first, and I'll come back then and I'll show you what happens in the alternatives. So here we have a bit of information about direct debit, it being the fastest, most reliable way to pay your contributions because it's automatic. So once everything is determined and contributions are submitted, we'll take it out by direct debit. So in this journey, I'm going to select direct debit. I'm going to move forward here, and there's a question put to us here to ask us, are we authorised to sign the mandate? So there's a challenge there put to the user. In this case, they're going to click on yes, and they're going to move forward by hitting save on the bottom. And here is now on screen the direct debit mandate, which we need the person to sign and agree to. So there's the information in the mandate itself. I know you can't see me pointing to the screen, but that's in the mandate in the blue box. And then we put in the bank account details for the company, and we can add in then that information. So we hit save and submit again. And there we are, registration is complete. That is it as far as being an employer having to set up for automatic enrolment. If I click on finish now, we'll see, again, it's a little bit early, but this is pretty much what the dashboard is going to look like. You'll see a breakdown on the dashboard, you'll see the amount of employees you have, you will see any outstanding contributions, there's history, and there's other options here which we won't go through today, but to use the service here, the portal, you can make manual contributions or you can upload files here directly. Again, they're for a different day, but all I want to show you back on this screen then is we have up top right, there's a little notification there for an inbox, which opens up as a mail. Now, obviously I don't have a mail there today, but that's just to represent there's a mail going to be in there, which basically covers your obligations as somebody now who's enrolled onto or registered into the scheme, about how to notify your employees and what your obligations are. The screen's acting a bit funny, 1 second there. If I click in there, you can see that's the mail. Now I've come back and I said there was a couple of alternative journeys. So in this case here, the person has selected direct debit as their preferred choice of payment. But at this point now, they're not the sole signatory required to authorise the mandate. So maybe they need somebody else, or just something which maybe the head of HR signs off, or somebody else in accounts typically signs off on it. So they've hit no here, and they get a couple of options. They can digitally obviously authorise or arrange for the authorised person to come onto the portal and say yes. So like that, they can log out, get the appropriate person, come back in and they can sign it. Or there's an option to do it by paper. So they can download the paper mandate, they can sign it, and there'll be an address there to send it to. And then that'll also be their application or registration complete. Now, if you don't want to use direct debit and you want to use a card payment, the difference obviously is when contributions are due, you'd be required to come onto the portal and pay with your card if that's the option you've made. So it takes a bit of that automatic piece out of it. There is a requirement every time there's contributions due to come on and pay with your card. So it is there as an option for people, but like that, there's a burden, I suppose, on the employer or the payroll operator or whoever it's going to be to come on every time there's contributions due to use that card to then make a payment. So I'll hit debit card, hit save and continue. And again, we're trying to emphasise that point here, that direct debit is easy. It's the most convenient way to do it. But here, I want to pay by card. I'm going to declare it. I hit my box to accept it. And what else is on screen then is an optional refund bank account. So in this instance, we don't have bank details because you haven't got a direct debit set up. But we do know there's instances in the future where there may be refunds due to an employer. And in that case, we ask the person here, do you want to supply the refund bank account today? And if you do so, we can use that when refunds are due to automatically send them. And again, that's optional. They can skip it. But if they want to do so, they can put in the bank details. They can hit the box on the bottom and they can save and continue. And that's the debit card journey finished. So it's almost the same, but just the last piece is different. It varies in that direct debit credit card space. And the last option we have here is skip. So I've done the first one, I've done the second one. Maybe I haven't made my mind up whether I want to use direct debit with the scheme. Maybe I want to feel it out for a while first. Or I don't have that information to hand, whether it's a bureau working for an employer and they haven't notified them, or they're just unsure what arrangement they want to make. They can skip for now. They can go to the dashboard. They'll still see the dashboard as the other two journeys did, but there's, on top of the screen now, there's a little reminder that you won't be able to make contributions because there's no payment method set up. So the system doesn't know whether you want to use direct debit or whether you're going to be a card payment user. And it's going to sit there until you make up your decision and you satisfy one of the two conditions. So this could be maybe the next week or the next day. When you log into the portal and you see it there, you can come into the journey and you can set up your payment method. And again, you'll have the same options there. You can go through direct debit or you can go through debit card. And you'll finish. And then you're back to your dashboard and you'll see that warning has now gone, because we have now all the pieces for it. So that is, I hope it felt fast, because it is supposed to be quite neat and short, and that's the employer registering for AE. That's as complicated as it gets. It's just a few terms and conditions at the beginning. It's your company breakdown, your contact details, and let's pick a method of payment, whether it be direct debit or notify us you're going to be a debit credit card user. And that's it. It's a bit whistle stop, but that's hopefully a good thing. Nice and neat. It's a quick registration, and that's it. Thank you.
So we'll move on now, I suppose, to the Q&A section. So we're joined again by Claire Dowling and John Egan to give you your answers. So I suppose best thing to do to start at the start. So if a weekly paid employee is on SSP and has been paid 70% of their salary for the first 5 days, will the employee still be paying 1.5% on the SSP? I suppose.
What's statutory sick pay? Okay. Yeah, question one back from me. What is SSP?
Most popular question, and those might be popular.
Is the most popular question. Okay. Like strictly speaking, MyFuture Fund isn't for people who are on other payments, but if your income is coming through payroll, through your employer, and whatever amount of money is in that gross pay box, then yes, that's what the contribution rate will be applied to. There won't be any mechanism for NERSA, if you like, to sort of carve out different kinds of income.
So thanks for that. So the next one, again, I think is for Claire. If an employee already has a PRSA, but auto-enrolment is more beneficial with the employer and state contribution, can that employee join the auto-enrolment scheme?
So the short answer is yes. As I mentioned, MyFuture Fund is, it kind of sweeps up people who aren't already in a pension, and so if they make that choice that they want to be in a different kind of a scheme, that takes precedence over MyFuture Fund. MyFuture Fund always comes second, if you like, in the hierarchy. Now, just one caveat to that, though, when the questioner here is talking about them having a PRSA, how is that PRSA paid? So if that PRSA is paid into through the employer's payroll, then NERSA will know and be able to see those contributions in that field. If not, then NERSA won't know. You know, NERSA won't have access to our bank accounts and our investments, and they won't know anything that's outside of that payroll world. So then it's just a question of, can the employee afford that PRSA, and do they want to continue having that PRSA in addition to auto-enrolment? Because they will be auto-enrolled if there's nothing in that pensions field on the payroll.
Thanks very much. So the next one, I think, is one of the ones that we covered in our the fact and fiction piece, but we'll ask it again. Can the state raid or levy the individual MyFuture Fund as it did from 2011 to 2016? And I presume, again, we'll pass this over to Claire.
This is a very political question, you know. I mean, the short answer is, like, no, there's no intention that anything like that could happen. This is, you know, it's private savings. That's the, you know, constitutionally the personal property of each individual participant. It's not, it can't therefore suffer the same fate, if you like, as the famous rainy day fund, because it isn't that kind of fund, it's individual savings. However, back in the dim and distant history, there were indeed sort of pension levies put on individual pension pots. Really, that is a question, like it's looking into a crystal ball, and it's for, you know, future governments. But definitely, you know, the short answer is no, and there's no intention, and you know that there would have to be some sort of disaster scenario again for something like that to happen.
So that's great. So this next question, I suppose, is for John, and it's, when is the portal going live?
The portal will be live. I don't have an exact date, but it'll be live early in December. So as we're getting ready to issue our first APNs, the portal will be there to take your registrations.
So the next question, how fair or realistic is it to expect employers to set up their employees for AE between early December, when the portal will go live, and January the 1st? Was there insufficient notice of the scheme to develop the portal in a timely manner?
So in that, the piece that went through there, that was the employer registration. So again, it was your terms and conditions, it was your company contact details basically, and then pick your payment method. From that point on, the employer is finished in any registration piece. The system itself will determine, through the revenue data that we receive, who's eligible to be on the scheme, and we will look after all of that piece. Through the use of payroll software, we'll notify payroll when a person's in the scheme. So what that means in January or whenever, when an employer is running payroll and they call the latest APN, it tells them which employers have a deduction. It'll be calculated automatically and sent into ourselves. So the registration piece, the workload that this person was fearing between December and January, it is just that walkthrough we went through on screen there. It realistically probably will take 5 minutes, and then the employer can wash their hands of it from that point going forward.
That's great. So the next question, how fair or realistic is it to expect... Sorry, next one again. If an employee joins their company pension plan whilst contributing to MyFuture Fund, understand that any overlapping contributions will be refunded and the member will be exempt for further deductions. Can you confirm how the employee and employer get the refund for the overlapping contributions? So again, I think John.
Yeah, so there'll be mechanisms, and I think I went through on screen the refund bank account. So again, when that happens and we see somebody has joined the scheme, there'll be an option to request a refund for those monies. I can't show you screens for that today, but there'll be, throughout the use of the portals, there'll be functionality there to request refunds.
So is it correct that all of your earnings are taken into consideration, including benefit in kind, health insurance, bonuses, etc.?
It's whatever appears in the gross pay field of payroll.
So the next one, employee has 2 positions and are paid in one payroll, and they get one pay slip. One of the positions is pensionable and the other is non-pensionable. Employer is obliged to auto-enroll for the non-pensionable pay. However, AE will ignore these as they'll see a pension on the pay slip. How should this be handled?
So that's a complicated one. Yeah, so that sounds unusual to me. Obviously, it may well happen very regularly. I don't know. But the way we look at it is we will look at individual employments and we'll treat them as individuals. So in the case of getting somebody enrolled in the first place and creating an APN, we look at combined income from both those employments. But when it comes to taking contributions, we only take a contribution on the gross pay for the employment that doesn't have a pre-existing pension contribution. So this one here, I'd need to see how that works at about appearing in the payslip. But in general, we will separate the 2 employments, and the percentage is only applied to the employment where it doesn't have a pension deduction already.
Thanks very much. And also, I suppose, just to remind people, if they want to send in queries through the mailbox, you'll be able to do that as well, and we'll get back to you on those. So at what stage does the employer notify the employee that they've been enrolled? Is it when they're advised of the APN, or will the employer get a separate confirmation of the employee has been enrolled and will then notify the employee?
So there will be communication sent to the, make sure I get this one right, sent to the employer on somebody being enrolled. So there'll be a communication which the employer can give to the employee. So it's like that, it's when it happens.
That's great. So if the employee is new to the country and no employment history in Ireland and on an hourly wage, at what point do they join, i.e. over 20,000? Is it extrapolated their hourly wage over a year, or look at the average of the past number of weeks?
So the way we look at it, once we see data coming in from revenue, and there's a payslip coming in where there's a PPSN number attached to it, we will assess over a period of time, a reference period, of whether that person should be enrolled in the system or not. So that's a 13-week look back. So we look back at 13 weeks, and every week goes past, we obviously drop the last week off, we add the new week on top of it. And once, at any point in that 13-week look back period, we get the salary totals €5,000, we will deem that to be the equivalent of earning €20,000 in a year, and that person will be enrolled. And to add to that answer, because it comes up a lot, people ask us about seasonal workers or part-time workers. To us, it's an employment, whether it's sporadic or whether it's very regular. And if in the 13-week look-back reference period, they hit the threshold earnings, we will employ them regardless of, or we'll enrol them regardless of the work pattern itself.
That's great. So if your employees' hours and wages fluctuate and it's different week on, week off, do you have to enrol them if you have no way to know whether they'll be, will or won't be over the €20,000 criteria in 2026?
So again, that kind of similar to the last answer. Once we look back at a reference period and the earnings are there to hit that threshold, the person is then enrolled in AE. From that point going forward, there's a percentage applied to gross pay. So if it's obviously zero because they're not working this week, there's no contribution due. And then obviously as it goes up or down, we just take a percentage of whatever that week's gross pay is. So like that if someone works very irregularly, maybe they work a couple of different jobs, one week they won't majorly in one and 1 week majorly in the other one. It doesn't matter to the system itself. We just apply the percentage to whatever is in gross pay that week for any employment which we can see coming in.
So if someone has a pension in place, let's say 4%, by the time AE reaches 6% and their own pension scheme is at 4%, does that mean that AE has to take over? So I'll pass that one to Claire, give John a bit of a rest.
Yeah, so we don't have the answer to that yet because those standards haven't been set. So the Pensions Authority is going to work over the next number of years with NERSA, the Auto-enrolment Authority, and they will look into, well, what kind of standard do we expect pension schemes to have in the interest of the employees in order for that to deem an employment exempt. So I don't know the answer to that now, and as I will say it again, it's not only about contribution rates because, you know, different pension schemes have different attractive benefits associated with them. So it's not just as simple as sort of comparing 4 to 6 and then saying, oh, well, 6 is better than 4, therefore. It won't be that simple, but I don't have the answer to it yet because those standards aren't set and they will be set in a number of years and not by me.
So for lump sum on drawdown, does that mean they can get 25% tax-free and use the balance to invest with one of the insurance companies by purchasing an annuity or investing in an ARF? I think Claire covered this, but we'll...
Yeah, I mean, strictly speaking, they could, and like that might not be a very attractive option for people with a very small pension pot for the first number of years of the scheme. I mean, they might just want to take it and go to Disneyland with the grandkids, you know, that will be up to them. But like in principle, the tax treatment for AE will be like that of a PRSA, so you get 25% tax relief on the lump sum, and then you can go and get some other kind of pension payment form that's available on the market, or by that stage maybe the authority will have developed its own products. But the Department of Finance is making sure to sort of align and sort of introduce MyFuture Fund into the normal pensions sphere, if you like, in terms of tax treatment.
So what happens to funds for the employee if they become sick or if they die? Is there a contribution particularly reimbursed to the family?
Yeah, so I can take that one, Paul, as well. So if a person becomes sick, actually I don't think I mentioned this, this is the only way that somebody could have early access to their savings pot under MyFuture Fund. It's accessible to them at the age of 66 unless they have actually retired early due to ill health, not just voluntary, if you like, early retirement. So the retirement due to ill health means that they can access their funds at that stage. Obviously, they have to provide evidence of that, but if they unfortunately pass away, it just forms part of their estate. It's like a savings pot. Any kind of the contents of a bank account that would go to a person's estate then for inheritance purposes then.
So if an individual is on a period of unpaid leave from work, for example, statutory maternity benefit, does the employer still pay the contributions?
No is the short answer. The employee or contribution is a matching contribution that an employee would pay. So if there's no pay, there's no percentage applied to the employee and the employer doesn't match it. If there is pay still coming in for a person, well then there is a contribution due on that gross pay and the employer will match it. So it depends on the situation of whether there is pay still coming through payroll for the person. If there's a contribution due by both employee and employer. If there's not, there's not in each case.
So the next one, what happens to proprietary directors who pay into a private pension by irregular lump sums, not through payroll? Will they be auto-enrolled?
So that one again, if we don't have visibility of the pension deduction, the person will be automatically enrolled in our system. Like that, it's because we're based on revenue information. We'll apply those few checks. We'll see the pension contribution. So if we can't see it and it's not in payroll, that person would in theory be enrolled into the system.
I suppose just to add to that, if they're on Class S, they'll be exempt.
Yeah, so like that we do have certain categories, and like that PRSI is one of them. And we have exemption PRSI classes, but that's the basic rule for us is if we can't see a deduction and you pass the rest of the criteria, you will come into the scheme. But like that we do have PRSI tests against it as well.
So can an employee earning less than €20,000 or under 23 years old opt into the scheme if they wish?
Yes, they can, as long as they're over 18.
So nice quick one. When an employee is due a refund of their contributions as they've opted out at month 7 or 8, who is responsible for repaying the refund, the employer or NERSA?
It'll come back through NERSA, so there'll be an action on the portal which they can request, and it'll be paid back through their own contributions.
To the employer, won't it? The employer will pass it on then to the employee, yeah.
So the FAQ state that employers are obliged to inform their employees when they've been enrolled and to inform them the date of enrolment. What is the format of this notification?
So there'll be a mail to the inbox on the portal, which will inform the employer it'll be the letter the employer will use to inform the employee of their now enrolment into the scheme.
So next one is if the employee opts out or suspends their contribution, does the employer still have to continue with their contributions on behalf of the employee? Plus, does the state continue to make their contribution?
No, so as long as the employee isn't paying, the state isn't paying either, neither is the employer. It's all three or none.
That's great. Flexi workers' gross earnings may change year to year due to their weekly hours. How are we calculating the 1.5% on a weekly basis on the gross weekly earnings?
Okay, so like that, when someone initially comes into the scheme, they're now on the scheme. Over the next 40 years, their work pattern might change drastically. They might leave employment for a period of time. What we do is when we see gross pay coming in for that person, no matter the schedule or the frequency or the amount of it, whether it's enormous or a small paycheck, they're enrolled into the scheme and that percentage is appropriate, whatever year it is applied to that gross pay. It's like that, and it comes up a lot, this question about seasonal workers. We may have Santa Claus coming in December. We will, if they're in the scheme, we'll take the deduction when we see gross pay, when we see pay coming in from revenue. So like that, depending on the pattern or whether you take breaks, you could be out of the workforce for 10 years and come back in. If you're in the scheme and we start seeing new pay slips coming in for you, we'll apply the percentage that's on the system to that gross pay and we'll assess the contribution based on that.
So just to say, if anyone has any more questions, you can still submit them. So with new hires, will NERSA wait until they hit the €20,000 threshold?
So it depends, and this is where Claire mentioned earlier on that you may not know somebody's enrolment status. You hire somebody, they may be with you only a week, but they could have already been enrolled in a scheme. If that's the case, when you run payroll and you get your latest APN, that person will be included. If it's somebody brand new into the workforce and there's no history of employment, that person will be enrolled if in the 13-week look-back period they hit the appropriate levels of earnings. It's like that. It depends. If it's brand new workforce, there's that period of time checking the reference period. If it's somebody who's been on the scheme at any point in the past, start working for you, they'll be in the latest APN.
So if someone who doesn't qualify but wants to join MyFuture Fund, how do they join?
So if there's I think this as in the voluntary opt-in, again with the parameters of 18 to 23, there'll be an option on the customer portal, which we haven't seen today, but there'll be an option there for someone to voluntary opt-in.
So does this apply to employees working on a Stamp 1 work permit?
So I believe so. Again, all we're looking at is employment, certain PSI levels. That is not not a pension deduction. If they satisfy those criteria, they'll be enrolled in the system.
Okay, so how does the direct debit work? How will you know the amount to take? Does a direct debit not just take a standard amount each month?
So every time you run your payroll and get your latest APN, and it applies the percentages to the gross pay for one or many in the payroll, that notification comes into NERSA. Let us know that for X, Y, and Z, these three people, this was their gross pay amount, this is the calculated deduction. When we know that information, that total amount is used then to start another mechanism which begins the collection through direct debit. So we will call it direct debit when we have the contribution information coming in from payroll.
Okay, so if a person is in dual jobs, how does it work?
So in the dual job, again, I'll probably sound very repetitive, but we'll at some point have assessed them if they've been enrolled in a system because of their earnings. Whenever any job, whether they have 2 or they have 10 employers, when they run latest APN, if they're in the scheme, they will see that person and they will just apply. Again, the system will apply the percentage to whatever the gross pay is across however amount of employers they have. When that all gets fed into NERSA as their contributions across various employers. So it doesn't really matter to the employer. There's no, for an employer who has a staff member who has multiple jobs, it's no different to them whether they have 1 or 10. The system deals with them all the same. They check latest APN, it applies a percentage to gross pay, and that gets notified to NERSA, regardless of the amount of employments they have.
So if an employee has a previous pension scheme from previous roles but no longer invests in a pension scheme, will they be required to join also enrolment?
So if they had a previous pension but they're no longer contributing to it, it's that same effect mentioned earlier before, that if we don't see it in payroll and you do satisfy the rest of the conditions, you'll be enrolled in the scheme. If we don't have visibility, you pass the test, you'll be in the system.
So if an employee removes themselves after the 7 months and is then re-enrolled, how long until they can withdraw or opt out again? Can they do it every 2 years? Can they every 2 years come out of the scheme?
Yeah, so for the opt-out options, you can opt out in months 7 and 8 after 6 months mandatory participation. That's when you first get enrolled, and it's also in months 7 and 8 after there's a rate change in the contribution rates. So those moments when it changes from 1.5% to 3% in year 3, year 4, I should say. And then when it changes from 3% to 4.5%, 3 years later, and again then when it changed from 4.5 to 6. So in those moments where there's a rate change, or that moment where the person is enrolled for the first time, they can opt out in months 7 and 8. They'll be automatically re-enrolled after 2 years, and then the whole process starts again. 6 months mandatory participation and the opt-out window of months 7 and 8, and that rolls all the way throughout their working lives.
So I think we've time probably just for one last question. So if someone enrolls into MyFuture Fund and then later joins company pension, how long will it take for NERSA to stop the MyFuture Fund contributions? Will it be automatic within 48 hours?
No, so it'll depend on the frequency of pay. So in that case, if for example, let's take a monthly paid person, we receive a pay slip, there's no pension contribution in it, we'll expect a deduction. Maybe the very next day they join the scheme, their scheme, it'll be a month before we see another pay slip. When that pay slip does come in and we now see there's a pension deduction, we will then put a break on the APN. We bring the percentage back down to 0. So it's us seeing a pay slip coming in with a pension contribution is when we will stop it. So it depends where the frequency that person's paid. Once we see the next pay slip, there's a deduction there, we'll then put a stop on it.
So we'll just, I suppose, open it up for the next 5 minutes if there are any questions in the room. If people want to raise their hand, we have a roaming mic.
I'm in an unusual situation where we have some people on weekly payroll where we pay them their basic in advance and then their overtime the following week. If I interpret it correctly, once the amount is paid, there's no way to kind of do a true up. Can you explain to me how that works, and do we need to look at maybe migrating them from paying advance for that portion to paying arrears so that they don't end up paying and having conflict about deductions?
So I couldn't quite hear all of that, but it's for us our system is I'm going to use it's quite simple. If pay comes in and it's in the appropriate gross pay fields, regardless of I suppose how that pay is constructed, whether it's overtime hours or whatever, if it's in there as basic as gross pay, we will assess that as for a contribution. So regardless of when it happens or how it's split up, once we see a pay slip coming in and there is a figure in gross pay, we'll apply contributions to it.
Sorry, just to qualify, maybe the question was confusing. We pay people, I suppose, in goodwill on the basis that they will get a full week's work. So, for example, if they're out sick and they've exceeded their deduction, we would deduct it the following week from them, but they'll have paid the contribution on the full week's pay, and then they won't get paid in the second week, if that makes sense.
Yeah.
Self-correcting then, isn't
Yeah.
it?
It might be one, again, to drop us an email, but for ourselves, like that we're limited to what's in the pay, and if there's a situation where somebody paid a contribution based on the amount of money that we see in gross pay, and it doesn't materialise for whatever reason, where the person called in sick, that then would be a situation between the employer and the employee. As far as we're concerned, we've applied the percentage to the gross pay, we've taken a deduction on it. If something happens outside of that, whatever the corrections would happen in the real world there, is between the employer and the employee at that stage. Whatever comes through payroll from that point going forward, whether it was corrected through payroll and maybe the gross pay is reduced the next week, well then obviously we'll apply a percentage to a reduced gross pay. So it depends on the situation, but realistically, when we see a gross pay coming in, we apply a percentage to that. If something happens in the meantime where that has not materialised, that's a matter between the employer and the employee at that stage. We can only deal with what we see coming into that gross pay field.
Is there an obligation for employers to engage with NERSA if membership to the company pension scheme is mandatory, like through contract?
So in regards to whether they need to interact with NERSA and like maybe carrying out the registration piece we've seen earlier on, in registering what it's doing, I suppose, is setting an employer up in case any of their employees get enrolled in the scheme. We have all the information in place. We possibly have direct debit, and we can go and collect contributions straight away. If a person or an employer, and this goes for people who have schemes or don't have schemes, if they don't register on the system here and one of their employees becomes enrolled in the scheme, contributions will be due, and they will be collected through payroll, even though the employer hasn't filled out the information on our website. But what will happen and where it will get stuck is when those contributions are due to be collected, if they haven't got a direct debit set up or they're not coming into the portal to pay, then obviously that money is now turned into a debt and there'll be interest applied to it. So it's in their best interest, as opposed to future-proof themselves by coming onto the portal and registering, because nobody knows, I suppose, what employees they have may or may not get enrolled in the system. So in that instance where it's a company who has a pension in place, in theory you could suggest that they don't need to come onto the website because all of their staff are going to be in their own scheme. But if it does entail that somebody isn't in the scheme and gets enrolled in the system, it will get to that point where we have contributions coming in for somebody and we don't have your employment details, which could result in that debt growing out and outstanding until it's satisfied. So like that, it's a case of you're better off registering in case your staff to get enrolled in the system. But in theory, like that, if you know realistically your staff are all in a scheme, there's probably not a big need for you to come onto the portal. But it's something which an employer will need to figure out and understand for themselves whether they should come on and register or not. All we would say is, if you come on and register and give us your information and direct debit set up, you're safe then if anybody ever gets enrolled in the system, because we have all the information that we need, and that whole debt growing occurrence won't happen.
Hi, thanks very much. It's been very informative this afternoon. We're a large employer in Ireland. We would have on average about 13,000 staff on a monthly basis that we're paying. And we've been engaging with our payroll software provider, who advised us that they're currently operating under an NDA and can't actually share an awful lot with us. We're deeply concerned because there's only really 13 weeks left in the year. So we're concerned about testing, development of the software. Like, where is it at? Can you give us any clarification on that and what we can expect?
Well, I suppose what I can say is that as we speak, the testing process is underway with the various bodies and software groups within the PSDA. They're dealing with the body that we have constructing the scheme itself. Obviously, we're at that point in time now where if issues comes up, we're fixed them in the live environment. So everybody is on schedule to be ready for the January launch. So your question there, I suppose, is we're all looking at January. We're all aiming for January. January is going to go ahead. We're going to have alternative solutions available. So, for example, we have an API solution for some payroll software companies. We have a file upload through the portal for companies maybe who want to use that as their primary or don't get their API solution developed in time. There's also a third option, which is a bit more manual, where if a payroll software isn't, I suppose, developed in time, or for whatever reason they're not developing for AE, there is a solution on the portal where an officer, a payroll operative, or HR, wherever the person would be, can come in and manually report on our own portal the gross pay for employees that are on that list. So there's solutions there. Just like there's 3 different channels. They're all going to be there for January, and obviously different payroll companies are at different phases of their testing and their development. So I can't speak for everyone here, but all I can say is January is on target for everybody to be delivering at least contributions to one of those 3 channels.
So I think the back.
Hi, yeah, thank you. We have a number of employees that would have permanent employment elsewhere. They're high earners in other employment, so would have a significant pension in that other employment. How does that work in the employment that they have with us, where it's kind of ad hoc hours?
So in that instance, it's likely based on the salary that person will be enrolled in the system, because we'll assess the income from both employments to see if they're eligible. But we only apply the AE contribution to the employment that doesn't have a pension. So like that, let's say it's somebody who has a pensionable job but works as a DJ on a Saturday night. If they're employed through a company and payroll, we'd assess that income from the Saturday night job. We don't apply the percentage to their main employment, which has the pension contribution in it.
There should be mention also, because I don't think I mentioned, the €80,000 cap might be relevant here for the higher earners.
Yeah, so in that instance, what Claire is referring to is there is a cut-off point. So as we're assessing income, whether it's across a single or multiple employments, if your earning hits the threshold of €80,000 in a calendar year, we'll cut your percentage back down to zero for the remainder of that year. So it's an 80,000 annual cap. Obviously begins at the start of the year. If you hit that in the end of August, you'll be paying no more contributions for the rest of the year. Come the next January, you'll be back at zero. You'll pay contributions again until you possibly do hit the 80,000 cap again. Whenever that happens, back to zero again until the next year.
Say they earn the full 80k in their other employment, so any income that they get from our employment, it doesn't.
It'd be an 80,000 cap on any employments that are eligible for the scheme.
Okay.
Thanks. Just a couple of things. The 13-week period, the initial one, the one that is to operate from January 1st, is that this 13 weeks starting from this week?
Yes. I couldn't say what date it is today, but
Okay,
yes.
but in that, so you're talking about €5,000 earned between now and December 31st.
Yes.
And yet at the same time, that is an incredibly busy time for many in retail, and some people wouldn't be working anything near those hours on another stage. So at the end of the 12-month period, they may well not have earned 20,000. They earned the 5,000. How does that work on a going forward basis?
So like that, it is based on a reference period. That reference period, like you said, it's 13 weeks. In theory, anybody who earns 5,000 in that reference period is enrolled in the scheme. So you're correct, if somebody could potentially earn €8,000 annually, but it's the majority of it comes at the end in a reference period of 13 weeks. That person will be enrolled, and obviously percentage will be applied then for any other earnings in that year. Whenever we see growth pay coming in, we'll apply the percentage. So it's a reference period it's based on, which is 5,000 in a quarter, which equates to that 20,000 annually figure. We're not assessing it over a year, we're assessing it over a quarter and 5,000.
The 20,000 is there for all times, is it?
Yeah, well, yeah, that's the.
It's in the legislation.
It's in the legislation, yeah.
So just on the payroll file there, if you've got an employee who, say, hasn't been in their occupational pension scheme the whole way up, and the end of December they decide to join, when that payroll file comes around in January, will there be an exemption or a comment section for employers to say, look, they've joined the occupational scheme, there's no need to auto-enroll them?
There isn't. And it's like that, the trigger for us to stop will be when we see a pension contribution coming in the door. So in that instance, if the timings happen that a person joins a pension scheme in that period when we're beginning to issue our first APNs, in theory those people will be collected up. When we see the first contribution coming in, then we'll stop. So like that, if it's that late where they join in the year, they will be caught up in it. If, for example, they do get their first pension deduction is November, we'll see that in time, and they wouldn't be enrolled because we could see it. Once we see it in a payslip coming in, we'd have it before January the 1st. So like that, they will be caught up if it's late in December where they join a scheme. We haven't seen a payroll coming in. The first payroll we see in January will have a contribution in it, and that's when we put a stop to it. So
just to confirm on that then, the final sort of contribution payroll is November and not December for employees joining occupational schemes?
To safely avoid it, yes. Yeah.
Thank you.
Hi, is it just in relation to occupational pension schemes that you'll be not enrolled or enrolled? So if an employee has a PRSA, for example, you don't see that on their payroll. How do they notify you, or how does the employer notify you of their existing pension?
Yeah, so it's any number of pensions, so it's not only occupational pensions that would deem you exempt. So it includes PRSAs and RACs and all of that. There's a number of types, if you like, and they're set out in the legislation. But this is a very relevant question in the sense of the payroll being central to this system. So if NERSA doesn't know that a person is paying into a PRSA because they're doing it separately through a standing order or directly from their bank account, well then they will potentially be auto-enrolled in respect of their employment. So they need to sort of think about that and maybe do something about that. They could either, decide whether or not they want to continue with the PRSA or at that level, or change the amounts, or ask their employer that it goes through payroll instead, if that's the only pension and sort of investment that they want to have on the go.
So it has to go through the payroll system to be exempt, is it?
Yeah.
Okay.
I just have a question, sorry, in relation to employees on income continuance. So in the company that I work in, it would be quite common for people to go on income continuance and then not opt in to continue their contributions, because obviously they're getting paid at a lower rate. But if the employer continued to pay towards their pension, and obviously there was no employee contributions, would that still be captured as being an active, even if there's no contribution from the employee? Yeah,
that's fine. As long as there's something going in through that pension pay field, it'll be picked up, and NERSA won't care, if you like, who's paying and who's not paying. As long as something is going into a pension scheme, that'll be exempt.
Thank you so much for all the information. I have a question on the employer registration. Am I correct in saying that all employers have to register?
Well, I would say all employers probably should register. Like in theory, if you're an employer who never has any staff enrolled in a scheme, you may never need to go near the portal itself. It's no harm for every employer to come onto the portal and register, because at any point in time they could have a staff member who's enrolled in the scheme. Again, in instances where they possibly are only working a few hours with somebody, they could be working in other places, which enrolls them in the scheme based on the collective earnings. And in that instance, the person could be enrolled, with you unaware that they might possibly be enrolled. So I'd say it's of no harm for people to register. It doesn't commit you to anything, but you'd be in place to go if any of your staff ever in the future get enrolled into the scheme. If you don't register and staff do get enrolled in the scheme, and contributions are recorded through payroll, like I said, if you haven't registered, there could be a situation arising where there's outstanding debt growing. So it's safe for everyone to come onto the portal and register. Again, it's not committing to anything, but it's just giving us your details in advance. So when or if any employees come into the scheme, you'd be good to go at that point going forward.
It's really informative, so thank you very much, guys. I just asked in relation to leaving jurisdiction. So we would have an awful lot of workers that would maybe stay in Ireland for a few years and then return to their home countries. How is that dealt with in relation to drawing down their pension, or can they?
So we thought about this and decided in our design that we wouldn't allow people to have early access to the pension pot or to the savings pot, except in cases of retirement due to ill health. So that's the only thing. I know other jurisdictions do allow that. I know in Australia, if you leave Australia within, something like 10 years of saving whatever, you can access that pot, and all you have to do is sort of raise your hand and say, no, I promise I won't be actually coming back. I want all of this money now. We don't have that design here. I suppose the thinking behind it in terms of just a policy decision, if you're interested, is just that we don't really know you know, what people will do, and often people don't know themselves what they'll do in the future, like if they'll be actually gone for good. So the decision was made to keep that money invested there until the person is 66. So, you know, they ought to, like if in those cases, they ought to remember their time in Ireland and keep note of that there's some money sitting in a pot for them they can access when they're 66 from wherever.